Should you choose a Roth 401k or a traditional 401k? This one decision can completely alter your finances for decades to come. I've seen too many people choose based on what sounds better instead of what actually fits their specific situation. I'm Kevin Pira, certified financial planner and founder at Pira Wealth, and in this video, I'll explain how these accounts work, which one makes the most sense for you, and the biggest mistakes to avoid before you change your 401k settings. Let's go. Let's start with the traditional 401k because that's the one most people are already familiar with. When you contribute to a traditional 401k, the money usually comes out of the paycheck before taxes. That means your taxable income for the year goes down and you owe less in taxes today. So here's a quick, simple example. Let's say you make $100,000 a year and you contribute $10,000 to your traditional 401k. Before other deductions and details, you may only be taxed as if you made $90,000. So you got the tax break today. Now that doesn't mean you avoided taxes forever. It means you push the tax bill into the future. When you pull pre-tax money out in retirement, those withdrawals are generally taxed as ordinary income. So your contributions and all the growth on top of them get taxed when you withdraw. In other words, a traditional 401k means a tax break today and a tax bill later. Now the Roth 401k flips that around. When you contribute to a Roth 401k, the contribution is made with after-tax dollars. So in plain English, you don't get the tax deduction today and your taxable income doesn't go down. But here's the major upside. If you meet the qualified distribution rules, your contributions and all of the growth on top of them can come out tax-free in retirement. So here's that same example. Let's say you make $100,000 and you contribute $10,000 to a Roth 401k. You still pay taxes this year as if you made $100,000, no deduction. But if that $10,000 grows for 30 years inside that Roth 401k, those qualified withdrawals later come out completely tax-free with the Roth. Remember, you're not skipping taxes here. You're choosing to pay them up front so that way future qualified withdrawals can be tax-free. So in other words, a Roth 401k means a tax bill today and then a tax break later. In 2026, you can contribute up to $24,500 between Roth and traditional 401ks combined. And if you're 50 or older, you can add an $8,000 catch-up contribution. And if you're between the ages of 60 and 63, your plan may allow what's called a super catch-up provision. The super catch-up is $11,250 instead. One quick advance note for higher earners, beginning in 2026, if your prior year FICA wages from that employer were over $150,000 and your plan has a Roth feature, catch-up contributions generally have to be made as Roth contributions. So if you're over 50 and a high earner, check how your employer's plan is handling that. Quick detour, because this confuses a lot of people. A Roth 401k is not the same thing as a Roth IRA. They have the same tax nickname, but they are different accounts with different rules. A Roth 401k is part of your employer's retirement plan. The money comes out of your paycheck, and your investment choices are limited to the plan menu from your employer. In 2026, you can contribute up to $24,500, not counting the catch-up contributions. A Roth IRA is opened separately at a brokerage like Fidelity, Schwab, or Vanguard. You fund them from your bank account. The 2026 limit is $7,500 or $8,600 if you're 50 or older. And Roth IRA direct contributions are subjected to income limitations, which the Roth 401k is not. A lot of people don't even realize that you can actually potentially use both of these accounts, since a Roth 401k and a Roth IRA have separate contribution limits. But for the rest of this video, we're going to be focused on the choice inside your workplace plan, so a Roth 401k or a traditional 401k. So how do you actually choose between them? The core question is this: is your tax rate likely higher now or later? And notice I'm saying tax rate, not just income, because those are not always the same thing. Your retirement tax picture can include Social Security, pensions, rental income, investment income, Roth conversions, and required minimum distributions. So don't assume retirement automatically means lower taxes. A person can have less income in retirement and still be surprised by taxes if Social Security, pensions, RMDs, and portfolio withdrawals all stack on top of each other. On the other hand, if you retire before Social Security or RMDs begin, some traditional 401k withdrawals may come at a relatively low effective tax rate, especially after the standard deduction. That's why this decision depends so much on your specific situation. If your tax rate is higher today than it will be in retirement, a traditional 401k may be the better choice. You're using the deduction now while it's worth more, and then you're paying taxes later when your rate is likely going to be lower. If your tax rate is lower today than it will be in retirement, then a Roth 401k may be the better choice. You're paying the tax bill while it's cheap and getting tax-free income later when your rate is higher. Let's get more specific. Who tends to benefit from a Roth 401k? Think of someone who is young and early in their career, maybe not in their peak earning years yet, and has 30 plus years before retirement. Roth can be attractive for that person because they're paying taxes today at likely a lower rate and giving that money decades to grow tax-free. More generally, a Roth 401k may make sense if you're younger and earlier in your career, you expect your income and your tax rate to go up over time, you want a bucket of tax-free money to withdraw from in retirement, and you don't really need to have that tax deduction today. Or maybe you just like the idea that your taxes are already paid. That doesn't mean every young person should automatically choose Roth, but it is why Roth often gets more attractive earlier in your career. Now on the other side, who tends to benefit from a traditional 401k? Think of someone who is in their highest earning years, maybe in the 32% tax bracket or higher, and trying to reduce taxable income today. For that person, the traditional deduction may be very valuable. More generally, a traditional 401k may make more sense if you're in your peak earning years, you're in a high tax bracket right now, you want to have that tax deduction today, and you expect your income and your tax rate to be lower in retirement. Or simply, you want to reduce your current taxable income. Now, that doesn't mean every high earner should automatically choose traditional, but the current year deduction can be very valuable when you're in a higher tax bracket now. Here's the part that makes this less stressful. You may not have to choose only one. Many 401k plans let you split your contributions between Roth and traditional inside the same plan. That can make sense if you're unsure about your future tax rates or you want flexibility later in retirement. It's not always 100% Roth or 100% traditional, and for some people, even a split 50-50 can be a reasonable starting point if you genuinely don't know which direction their tax rate is going to go and they aren't clearly in one camp. From there, you can tilt one way or the other based on your specific situation. The point is that you're not locked into picking one bucket forever. Before you make your choice, watch out for these 5 common mistakes. Mistake 1, thinking Roth is always better. A lot of online content makes Roth sound like the obvious winner. It's not. If you're in a high tax bracket now and you expect to be in a lower one later, the traditional deduction can be extremely valuable. Roth is not just automatically the right answer just because it sounds better on social media. Mistake number 2, forgetting that traditional withdrawals are taxable. People look at their 401k balance and think of the whole number as their money. It's not. If it's pre-tax, some of that balance belongs to the IRS. So when you're planning for retirement, make sure you're thinking in after-tax dollars. Mistake number 3 is not investing the tax savings. So this is a big one. People compare $10,000 going into a Roth with $10,000 going into traditional and act like it's apples to apples, but it is not. If the traditional contributions save you $2,000 or $3,000 in taxes today, what did you do with the tax savings? Did you invest it? Did you just save it? Or did it just disappear into your checkings account? Because if you actually invest the tax savings, the traditional can be much more competitive. If you spend the tax savings, then a Roth may work better behaviorally because you already paid the tax bill. Mistake 4, forgetting about required minimum distributions. At some point, pre-tax retirement money cannot stay tax deferred forever. Once RMDs apply, the IRS requires you to start pulling money out each year, whether you need the income or not. Those withdrawals are also generally taxed as ordinary income, and they can stack on top of Social Security and other retirement income. So a large traditional 401k or a rollover IRA balance can create a big forced tax bill. Roth 401ks are different. Starting in 2024, Roth 401ks no longer require lifetime RMDs for the original owner, which gives you more control of when and how you plan to use that money. That is a major planning advantage that many people overlook when they choose between the Roth and the traditional in their 30s, their 40s, and their 50s. Mistake number 5, assuming your employer match follows your Roth choice. Even if you contribute to a Roth 401k, your employer match may still be treated differently. Many plans still put employer contributions into a pre-tax bucket. There are some plans that now allow the Roth employer contributions, but you need to check your plan before you just assume that the employer contributions are going to be Roth as well. Here's the bottom line. Roth and traditional 401ks are both great tools. The question isn't which one is always better. The question is which one fits your specific situation right now and what you reasonably expect to happen later. If you want a personalized approach to which one fits your specific situation, the link to schedule a conversation with me is in the description below. And if this video helped you understand the difference, hit subscribe for more practical retirement and tax planning videos. Thank you so much for watching, and take care.